457B. It's a deferred compensation plan. It was created in 1978. Refers to Section 457B of the Internal Revenue Code. They're not real creative down there. They just said, what number is that? That's what we call it. So it's a tax advantage retirement plan for government employers. The city of Indianapolis provides the plan, and the employees defer compensation into it on a pre-tax, or now you can do an after-tax basis. So, and we'll talk about both of those. That's the difference in this year's presentation. So you can do a pre-tax or after-tax. So the members set aside money in retirement through a salary deferral with the city, and then the members take you take a reduced salary, and that money is directed to an individual investment company account. It's in an account in your name. That's your money that you're setting aside. So the traditional 457B that's been around since 1978 is employers make a pre-tax contributions through a salary reduction or deferral. The taxable income for federal and state income tax purposes is reduced. It's never actually coming into your check. So you're at the end of the year, your taxable, your state and federal taxes are based on a lower amount because you're deferring that salary, not taking it yet. And those contributions don't reduce your wages for the purposes of FICA taxes. So you're still paying a Medicare tax and all that. You're still paying into that system, but you don't pay the taxes on your income. Investment growth is tax-free. So while that money is invested in an account that you've set up, it grows tax-free. You don't pay taxes on it. You pay taxes on it at the normal rate at the time you withdraw at retirement or upon termination of employment. And this is a big thing too. This benefit is not, you don't have to have, it's not subject to the 59.5 rule. So this means that there's no penalty for early withdrawal at retirement, like an IRA you might have had from another employer, or if you set up your own, like a brokerage account or something like that. There is no 59.5 rule for the traditional 457. So it's perfectly suited for public employees, firemen and police especially. If you come on at 21 and you work 25 or 30 years, well, you're not 59.5 yet, but you're ready to go. You can use this money when you retire, so you can start drawing it without any penalty. Generally, your withdrawals have to begin at age 73. The IRS has deferred those taxes, but at some point they're going to make you start paying them and start taking money so they can start collecting their taxes. The Roth 457B, in 2010, that they changed the tax code or amended it to include a Roth 457. So this it's similar. There are some things, some tweaks a little bit. The employees make an after-tax contribution. So you pay taxes on your full salary, and then you set money aside into your Roth account, and that money. So you've already paid the taxes up front. The money grows tax-free, and it comes out tax-free. It's just like a Roth IRA in that regard. Roth was a senator, and that's who they named it. He named it after himself. So that money comes out tax-free. You pay the taxes up front, so your salary is reduced by the full amount. If you want to put $100 or $1,000 a month into your Roth account, it's coming. You pay the taxes on, and your salary goes bound by that exact amount. On the traditional 457, you can if you put $100 in there, it's really only going to impact your salary by about your take-home pay by about $75 because the taxes aren't coming off. So you're putting $100 in, but you're actually you would have only gotten about 75 of it in your pocket. So that's the difference on one of the differences on these two. The withdrawals on the Roth 457 are subject to the 5-year rule and the 59.5 rule. One of those things they just didn't change when they put this in. So it's like your regular IRA and your Roth IRA that you might have somewhere else. You can't draw this money out to 59.5 without a penalty, for it to be the Roth benefit, it has to be 5 years. The account has to be 5 years old, there is the one upside to that is there is no required minimum distribution. Since you've already paid your taxes, they don't care when you take the money out, and it is a tax-free inheritance to your beneficiary for 10 years. So if you have a Roth account that when you pass away, your beneficiaries can just draw money off of their tax-free for 10 years, and then if there's any left, they can roll it into their own Roth IRA and it stays tax-free, or they can just pay taxes on the amount that's left. But so that's a nice little vehicle for your estate planning, so to speak. I'll come back to it. So the pros and cons of or pros and things to think about, because they're not really bad, but they're just something to think about. We do get a matching contribution. is a tax advantage, so you're not paying. It grows and comes out with a tax advantage. Maybe used to make up or supplement that retiree income, again, that 52 to 76%, and your drop money or whatever. Well, this is a way to bridge that gap. It's investable and it is inheritable. So this money, again, is yours. It's your individual account. You own it. It's got nothing to do with the pension or anything else. So that money's yours. That's part of your estate when you retire or when you pass away. Things to think about, though: you are reducing your income during your working life. I mean, you're taking less money, either pre-tax or after tax. You're getting less money in your paycheck every time you put it in there. So people say, well, I can't afford to do that right now. It's like, well, again, you are taking money out of your pocket right now, delayed gratification for something that for your retirement. Your returns are not guaranteed. Your investments might lose money. And the 59.5 rule is important. If you come on the job at 21, well, you got to work 38.5 years before you can draw that. So the Roth might not be the best deal for you if you came on at 21 and don't want to work 40 years to get to have access to this money. So again, for most of us that come on a little later or started putting the money in, they didn't start putting this money in until 2010. You couldn't do it. So you might have a Roth contribution and a traditional. You can have those accounts. You can choose which way